The date is July 15, 1815. The location, Waterloo, Belgium. Napoleon Bonaparte and his Grande Armée were engaged in a decisive confrontation against the combined might of the British and Prussian forces, a battle poised to determine the geopolitical destiny of Europe. 200 miles distant in London, Nathan Mayer Rothschild occupied his customary seat within the bustling London Stock Exchange. Rothschild possessed a unique, invaluable asset that was inaccessible to all others: information. His private courier network, established as the fastest in all of Europe, utilized a sophisticated relay system of carrier pigeons and tireless riders to deliver news from the combat zone to London in an astonishing 24 hours. While the rest of the financial world would anxiously await official dispatches for 3 agonizing days, Rothschild had real-time intelligence. On the late afternoon of July 19, Rothschild's courier finally arrived with the crucial message: Wellington was victorious. Napoleon had been definitively defeated. But Rothschild did not announce the victory. Instead, he initiated a massive, aggressive sell-off of British government bonds. Observing the patriarch's frantic divestment, other traders erupted in panic. The universal assumption was immediate: Rothschild, the man with the best connections, must know something terrible. Wellington must have failed, Napoleon must be marching toward London. They, too, began liquidating their holdings in a desperate frenzy. The price of British consols plummeted, nearing collapse. It was at this critical juncture that Rothschild's agents, strategically positioned across the trading floor, commenced buying everything back at distressingly low, rock-bottom prices. The very next day, the official news arrived, confirming Wellington's triumph. British bonds immediately skyrocketed in value. Rothschild had executed a perfect maneuver, netting an estimated $40 million in a single day, a staggering sum equivalent to approximately $5 billion in modern currency. This was not considered insider trading; laws against such practices did not yet exist. This was a masterclass in information arbitrage, flawlessly executed by the most powerful banking family on the continent. It was a stark demonstration of a principle that would define the subsequent 2 centuries: control over information and capital grants control over nations, not through military conquest, but through the leveraging of debt. Over the following 210 years, a handful of influential banking dynasties, 5 in total, would systematically construct the architecture of the modern financial system. Their strategy involved financing both sides of major global conflicts. They engineered the creation of central banks across 3 continents and established the foundational institutions that regulate global finance today. In doing so, they amassed a concentration of wealth and political influence that far surpassed the might wielded by any king or emperor in history. Crucially, these families did not operate in the shadows. Their rise occurred in plain sight, verifiable through documented transactions, recorded meetings, and formally established institutions. Their power was not clandestine; it was legitimized through codified law, formalized government partnerships, and, most effectively, through the deliberate creation of financial systems so Byzantine and complex that few felt qualified to question their underlying design or originators. What follows are the 5 critical stages detailing how these banking dynasties constructed the modern financial system, outlining which families controlled each phase, how they leveraged massive government debt to gain political control, the specific global institutions they birthed, and the reason why this structure now oversees $100 trillion in assets while operating largely beyond the regulatory purview of any single national government. Understanding this narrative is not about embracing conspiracy theories; it is simply confronting financial history. The key distinction is that conventional financial history concentrates on volatile markets, public policies, and abstract economic theory. This analysis, however, shines a light on the families who actually engineered the system, the key institutions they established, and the proprietary mechanisms they embedded to guarantee their enduring power for centuries to come. Before delving into the 5 stages, we must grasp the underlying business model that served as the engine for these dynasties. It was brutally simple, comprising 3 core tenets: finance both belligerent sides of every conflict, maintain strict political neutrality, and guarantee that the eventual victor is fundamentally indebted to you. Throughout the 18th century, European monarchs faced incessant demands for capital. Expenditures on wars, the construction of elaborate palaces, and critical infrastructure projects all necessitated vast funding. However, kings lacked the modern governmental toolset of selling public stock or easily issuing treasury bonds. They were entirely dependent on private bankers who were capable and willing to advance enormous sums. Traditional banking institutions of the era were inherently restricted by geographic boundaries. A bank located in London could lend money to the British Crown, a Parisian bank financed the French state. Yet, no single banking house possessed a truly border-spanning operation, with the singular exception of the Rothschild family. Mayer Amschel Rothschild initiated his career as a modest coin dealer in Frankfurt during the 1760s. He had 5 sons. In the early 1800s, Mayer Amschel strategically dispatched each of his sons to establish operations in a major financial capital across the continent. Nathan was sent to London, James to Paris, Salomon to Vienna, Karl to Naples, while Amschel remained in Frankfurt. This strategic deployment instantly forged a powerful banking network that stretched across all of Europe. The 5 brothers could seamlessly transfer funds across national borders through internal family transactions, thereby circumventing the conventional restrictions imposed on international finance. And most critically, this structure allowed them to finance multiple, often warring, governments simultaneously. When Great Britain engaged in conflict with France, the Rothschild network provided capital to both sides, lending to the British government from London and the French government from Paris. The underlying guarantee was simple: regardless of the outcome of the conflict, the winning nation would be obligated to repay its debt. The Rothschilds were essentially assured of profit, regardless of geopolitical shifts. This robust business model, financing every side of every major conflict, became the bedrock of their dynastic banking power. This reality imparted a crucial lesson to governments worldwide: wars are ultimately decided, not by the size of the army, but by the ability to borrow and sustain the most credit. By 1815, following the success at Waterloo, the Rothschild family had consolidated their position as the single most powerful financial institution in Europe. They held a greater portfolio of government debt than any competitor, possessed the continent's fastest information network, and had definitively proven their unique ability to move money internationally, circumventing restrictions in ways no other banking house could emulate. We now examine how they leveraged that immense power to seize control over national monetary systems. Stage 1 of dynastic banking power: control government debt, control the government. This principle is the bedrock. Every subsequent layer of control is built upon this foundation. In the aftermath of Waterloo, European governments found themselves utterly submerged in debt. Decades of ceaseless warfare had fiscally bankrupted nations including France, Great Britain, Austria, Prussia, and Russia. All were massively indebted to the Rothschilds and a few allied banking houses. Nathan Rothschild, operating out of London, swiftly became the dominant financier of the British government. Whenever Britain required new capital, it was to Rothschild that they turned. He would underwrite the necessary government bonds, syndicate them for sale to investors, and charge substantial fees on every transaction managed. By the 1820s, Rothschild exercised virtual control over the issuance of all British government debt. He dictated the interest rates and determined which investors gained access to the lucrative bonds. Critically, if the British government attempted to pursue any foreign or domestic policy that Rothschild disapproved of, he possessed the ability to refuse financing. This effectively granted Rothschild veto power over major aspects of British fiscal policy, all without holding any official, elected, or appointed government position. This same strategic pattern was meticulously replicated across the continent. James de Rothschild in Paris financed the restored French monarchy. Salomon von Rothschild in Vienna served as the chief financier for the sprawling Austrian Empire. Karl von Rothschild in Naples held sway over the finances of the Kingdom of Naples. By 1830, the Rothschild family was estimated to hold 50% of all outstanding government bonds in Europe. Consider the magnitude of that figure: half of the continent's entire governmental debt liability was owed directly to a single, interconnected family. However, controlling government debt was merely the precursor. The true zenith of power lay in controlling the monetary system itself. During the 1820s and 1830s, most European governments adhered rigidly to the gold standard, meaning their national currencies were required to be backed by physical gold reserves. Because the amount of gold in circulation was finite, governments were severely constrained. They could not freely print money beyond their reserve capacity. This constraint could only be bypassed through the creation of a central bank. A central bank is defined as an institution that holds a monopoly over the money supply. It possesses the sovereign right to issue currency, determine key interest rates, and lend money to the government, often without the strict limitations of gold backing. Although Britain established the Bank of England in 1694, it was structured as a private institution held by shareholders, and by the 1820s, the Rothschilds were key major shareholders. Most other European nations still lacked a true central bank. They maintained government treasuries responsible for taxation and expenditure, but they had no dedicated institution solely responsible for controlling the national money supply. The Rothschilds aggressively advocated for the establishment of new central banks throughout Europe. Their motivation was clear: central banks possessed the singular ability to create new money to settle outstanding government debts, and the Rothschilds were the principal creditors of those debts. In Austria, Salomon von Rothschild was instrumental in the establishment of the Austrian National Bank. In France, James de Rothschild wielded significant influence over the Bank of France. In Italy, Karl von Rothschild collaborated closely with the Bank of Naples. Crucially, these institutions were not governmental entities, they were private banks that had been granted the monopoly power to issue the national currency. The Rothschilds were either major shareholders or key primary creditors to all of these institutions. By 1850, the Rothschild family maintained profound influence over monetary policy spanning Britain, France, Austria, Naples, and Prussia. They had no need for public office, they simply controlled the institutions that controlled the money supply. However, Europe was an established, saturated market. The greatest untapped opportunity lay in a new nation boasting unlimited economic potential and lacking any entrenched financial system: America. Stage 2. Expand to America and integrate U.S. capital into the European system, 1830s to 1913. In the early 1800s, the United States was vehemently opposed to the concept of a central bank. The first Bank of the United States operated from 1791 to 1811 before its charter was allowed to expire. The Second Bank of the United States existed from 1816 to 1836, only to be dismantled by President Andrew Jackson, who fundamentally despised central banking, believing it dangerously centralized power among a small group of wealthy elites. Jackson famously declared, "You are a den of vipers and thieves. I intend to rout you out, and by the eternal God, I will rout you out." He was successful. The charter for the Second Bank was not renewed when it expired in 1836, resulting in the United States operating without a central bank for the following 77 years. Despite this resistance, America desperately required capital. The construction of railroads, burgeoning factories, and nationwide infrastructure demanded immense investment. American banks simply lacked the necessary reserves, forcing the nation to turn toward Europe. British and continental European capital, a significant portion of which originated from Rothschild coffers, flooded in to finance American expansion. Rothschild agents and affiliated banks in New York served as the primary conduits for these crucial transactions. August Belmont arrived in New York in 1837, formally establishing himself as the Rothschild family's designated agent in America. He founded August Belmont and Company, which quickly rose to become one of the most formidable banking houses in New York. Belmont extensively financed railroads, subscribed to government bonds, and underwrote industrial expansion. Crucially, Belmont's objective was not to build an independent American bank, but rather to integrate American capital markets directly into the vast European financial system controlled by the Rothschilds. During the American Civil War, both the Union and the Confederacy required enormous funds. European banks, including those affiliated with the Rothschilds, once again financed both warring factions. The North successfully issued bonds marketed in London, while the South, though attempting the same strategy, met with less success. Following the conclusion of the war, American industry experienced an explosive expansion across sectors like steel, railroads, oil, and manufacturing. This demanded staggering amounts of capital, which was willingly supplied by European banks. Yet, by the 1880s and 1890s, a new, uniquely formidable power began to surface in American finance. He was not directly European or merely Rothschild affiliated, but purportedly purely American: John Pierpont Morgan. Born in 1837 to an affluent banking family, Morgan benefited from his father, Junius Spencer Morgan, running a prominent merchant bank in London. J.P. Morgan launched his career in his father's institution, thoroughly mastering the intricacies of European finance. In 1871, Morgan formed a powerful partnership with the Drexel family, establishing Drexel, Morgan & Company in New York, later renamed J.P. Morgan & Company. Morgan's method for accumulating power was revolutionary: industrial consolidation. He systematically merged competing entities into massive monopolies. His masterpiece was the creation of U.S. Steel, achieved by combining Carnegie Steel and numerous other enterprises into a single $1 billion corporation, the first billion-dollar company ever recorded. He consolidated America's railroads and expertly restructured failing companies, ultimately establishing himself as the indisputable, most powerful banker in America. By 1900, J.P. Morgan controlled more capital than any other American bank. However, he was never truly independent. He remained intrinsically linked to European banking via his father's London bank and deep partnerships with Rothschild-affiliated institutions. Morgan served as the critical bridge, channeling European capital into America while exporting vast American wealth back across the Atlantic. This bridge became vitally important during the economic crisis of 1907. The Panic of 1907 began with the failure of the Knickerbocker Trust Company, immediately triggering massive bank runs throughout New York City. Depositors frantically rushed to withdraw their funds, draining the insufficient cash reserves held by banks. The entire banking system was mere hours away from a catastrophic, total collapse. The U.S. government was powerless to intervene, possessing no mechanism to halt the crisis. America had no central bank and therefore, no lender of last resort. J.P. Morgan dramatically stepped into the void. He famously locked New York's most influential bankers inside his personal library and compelled them to create a massive pool of liquidity to stabilize the failing institutions. Morgan personally exercised the authority to determine which banks would receive bailouts and which would be allowed to fail. The crisis was contained, and the financial system survived. But the event delivered a powerful, undeniable lesson to Wall Street: America urgently needed a central bank, and that institution must be fundamentally controlled by private bankers, not by governmental politicians. This realization leads directly to stage 3, create the Federal Reserve and establish control over U.S. monetary policy. On the night of November 22, 1910, 7 highly influential men quietly boarded a private train car at a secluded New Jersey railway station. The train traveled in absolute secrecy to Jekyll Island, Georgia, an exclusive, private resort owned jointly by J.P. Morgan and several other immensely wealthy families. These 7 men spent 9 uninterrupted days at the Jekyll Island Club, dedicated to secretly drafting the comprehensive legislation that would eventually become the Federal Reserve Act. The attendees included Nelson Aldrich, U.S. Senator and Chairman of the National Monetary Commission. His familial link to the Rockefeller dynasty was cemented when his daughter married John D. Rockefeller Jr. Frank Vanderlip, president of National City Bank of New York, which would later evolve into Citibank. Paul Warburg, partner at the investment firm Kuhn, Loeb & Company, a major institution with powerful ties to the Rothschild network. Paul's brother, Max Warburg, ran M. Warburg & Company in Germany, maintaining crucial financial relationships with the European banking families. Henry P. Davison, a senior partner at J.P. Morgan & Company. Benjamin Strong, vice president at Bankers Trust, who was slated to become the first governor of the Federal Reserve Bank of New York. Charles D. Norton, president of First National Bank of New York. Piatt Andrew, assistant secretary of the Treasury, the sole government official present. These 7 individuals represented the unified interests of the Morgans, Rockefellers, Warburgs, and the largest financial institutions on Wall Street. They drafted the Federal Reserve Act in utter secrecy because the American public held a deep-seated historical antagonism toward the very concept of a central bank. Andrew Jackson's defeat of the Second Bank was still a potent symbol, and populist politicians routinely railed against the manipulative power of Eastern banking interests. Had the public understood that Wall Street bankers were the true architects of a new central bank, the legislation would have stood no chance of passing Congress. Therefore, they meticulously disguised the institution's true nature. First, they deliberately named it the Federal Reserve System, eschewing the provocative title of the Central Bank of the United States. The inclusion of the word federal lent it a false air of governmental authority. Second, they engineered a system of regional Federal Reserve banks, creating the illusion of decentralization. In reality, the Federal Reserve Bank of New York, firmly controlled by Wall Street, concentrated the vast majority of operational power. Third, and most pivotally, they structured the Fed as a private corporation, legally owned by its member banks, not the government. While the government reserved the right to appoint the Board of Governors, the shareholders, and thus the beneficiaries of the system, would be private financial institutions. The Federal Reserve Act was officially introduced to Congress in 1913. Due to its sheer complexity, the bill spanned over 1,000 pages. Most congressmen admitted they did not fully comprehend its contents. The act was pushed through the House on December 22, 1913, and the Senate on December 23, strategically passing just before the Christmas recess when most dissenting members had already departed Washington. President Woodrow Wilson signed it into law on December 23, 1913. The Federal Reserve officially commenced operations in 1914. Benjamin Strong, one of the original Jekyll Island attendees, assumed the powerful role as the first governor of the New York Fed, effectively overseeing U.S. monetary policy for the subsequent 14 years until his death in 1928. Paul Warburg, the partner with deep ties to European banking, was appointed a member of the Federal Reserve Board. The structural design guaranteed that Wall Street banks would maintain operational control over monetary policy. The New York Fed, specifically, managed the largest gold reserves, executed crucial open market operations, and maintained the direct, institutional relationships with the central banks of Europe. The shareholders of the entire Federal Reserve System, the private member banks, including J.P. Morgan, National City Bank, and First National Bank, all possessed ownership shares in the Federal Reserve. This resulted in a system where private financial institutions held ownership of the body that controls the entire U.S. money supply. While the government appointed certain oversight officials, operational authority resided firmly with Wall Street, and the crucial connections to the European banking dynasties remained unbroken. Paul Warburg maintained regular communication with his brother in Germany and with Rothschild-affiliated banks across the continent. J.P. Morgan's partnerships with European institutions seamlessly continued. The Federal Reserve, therefore, was not conceived by the government for the public good, it was engineered by bankers, explicitly to serve the interests of banks. And its first major function was immediate, financing America's entry into World War I. Between 1914 and 1918, the Federal Reserve generated over $25 billion in new currency to fund the war effort. This money was then lent to the government, complete with interest charges. The government accrued debt, the Fed created the currency, and the private banks collected the profit. However, the ultimate consolidation of global power materialized after the conflict concluded. Stage 4. Consolidate power through world wars and create global institutions, 1914 to 1945. World War I fundamentally fractured and reshaped the global financial structure. Economically, Europe was left devastated. Both Britain and France amassed enormous debts owed to American banks, while Germany was utterly crushed under the burden of insurmountable war reparations. The banking dynasties, naturally, financed every aspect of this upheaval. J.P. Morgan & Company served as the principal underwriter for British and French war bonds, loaning over $3 billion to the Allies during the war, a sum equivalent to more than $70 billion today. The Rothschild network continued to finance various governments across Europe. Meanwhile, the Warburg family, strategically split between Germany and America, maintained banking relationships with individuals on both sides of the conflict. After the war, J.P. Morgan & Company cemented its status as the world's most powerful bank, orchestrating the massive loans required for Europe's rebuilding. It held more sovereign government debt than any institution had ever held before. By the 1920s, J.P. Morgan & Company, alongside Kuhn, Loeb & Company, and the Rockefeller-controlled National City Bank, utterly dominated American finance. Then, in 1929, the stock market crashed, leading to the collapse of the banking system and the failure of thousands of smaller banks. Yet, the major dynasties survived intact. J.P. Morgan & Company survived. National City survived. Kuhn, Loeb & Company survived. They possessed sufficient capital reserves and deep governmental connections to withstand the systemic crisis. The Glass-Steagall Act of 1933 legally compelled J.P. Morgan & Company to separate its operations into a commercial bank, J.P. Morgan & Company, and an investment bank, Morgan Stanley. However, control over both entities remained securely in the hands of the same dynastic families. Then, World War II erupted. J.P. Morgan, the Rockefellers, and other American banking interests financed the entirety of the Allied war effort. The U.S. government borrowed more than $260 billion to prosecute the war, the Federal Reserve created the necessary currency, and the private banks underwrote the bonds. By 1945, the United States held two-thirds of the world's gold reserves. American banks were virtually the only major financial institutions left operational, European banks were in ruins, and the British Empire was fiscally bankrupt. This represented the watershed moment when global financial power decisively and permanently shifted from Europe to America. Naturally, the banking dynasties that held sway over American finance were the ones who designed the subsequent post-war system. In July 1944, representatives from 44 nations convened at Bretton Woods, New Hampshire, to construct the framework for the post-war global financial system. Key public figures included John Maynard Keynes representing Great Britain and Harry Dexter White for the United States. Yet, operating behind the scenes were the powerful banking interests who stood to be the primary beneficiaries of this new structure. The Bretton Woods Agreement formally established two monumental institutions, the International Monetary Fund, IMF, tasked with managing international currency stability, and the World Bank, responsible for financing reconstruction and global development. Both were strategically headquartered in Washington, D.C., funded by member nations but ultimately controlled by the largest shareholders, chiefly the United States. Most critically, the agreement designated the U.S. dollar as the global reserve currency, which itself was pegged to gold at a fixed rate of $35 per ounce. Every other major world currency would, in turn, be pegged to the dollar. This structure granted the United States, and by direct extension, the banking houses controlling American finance, unprecedented authority over the entire global monetary system. However, there was a third, older institution, established even earlier, whose existence remains largely unknown to the public, the Bank for International Settlements, BIS. The BIS was founded in 1930 in Basel, Switzerland. Its official mandate was handling German war reparations after World War I, but its actual, enduring purpose was to coordinate and synchronize central bank policy globally. The BIS is uniquely owned by central banks, and only central banks such as the Federal Reserve, the Bank of England, the Bundesbank, and the Bank of Japan can be members and shareholders. The BIS operates above the reach of any single national government. It enjoys full diplomatic immunity from Swiss law, cannot be prosecuted, and conducts its meetings in complete secrecy. Its fundamental role is to harmonize the monetary policies of the world's central banks. Astonishingly, during World War II, the BIS continued its operations, despite its board members including central bankers from both Allied and Axis nations. The BIS even facilitated certain financial transactions between Germany and other countries throughout the conflict. After the war concluded, the BIS not only remained operational but also grew into the chief coordinating body for the newly designed post-war financial system. Thus, by 1945, the banking dynasties had successfully installed three layers of global institutions, the Federal Reserve, 1913, the BIS, 1930, and the IMF and World Bank, 1944. This structure provided the bankers with layered control, authority over U.S. monetary policy, centralized coordination among global central banks, and immense leverage over developing nations via IMF conditional loans. The controlling families, the Morgans, Rockefellers, and Warburgs, maintained their dominance through key board positions, strategic ownership stakes, and a continuous revolving door system ensuring that key personnel constantly rotated between high-level government offices and financial institutions. Despite this massive consolidation of power, the entire system still fundamentally relied on the U.S. dollar being convertible to gold. This requirement represented the last remaining constraint, severely limiting how much money the system could create. In 1971, that critical constraint was deliberately severed. Stage 5, break the gold link and create the pure fiat system, 1971 to present. This stage marks the beginning of the modern financial era. By the late 1960s, the Bretton Woods system was visibly crumbling. The United States had engaged in aggressive monetary expansion, printing vast quantities of dollars to fund both the Vietnam War and extensive Great Society domestic programs. Consequently, the sheer volume of circulating dollars massively outpaced the actual gold reserves held to back them. Foreign governments, spearheaded by France under President Charles de Gaulle, began systematically demanding to exchange their dollar reserves for gold bullion at the official, fixed rate of $35 per ounce. This all changed dramatically on August 15, 1971, when President Richard Nixon officially closed the gold window. This move ended gold redemptions, severing the dollar's final link to any tangible asset. Consequently, the dollar, and by extension virtually every other global currency, was instantly transformed into pure fiat money, backed solely by the faith and credit of government promises. This seismic shift represents the most significant monetary change in modern history, effectively granting central banks, like the Federal Reserve, the unprecedented and virtually unlimited power to create money from nothing. Freed from the constraints of gold backing, the Federal Reserve now possessed the ability to conjure as much money as the economy seemed to require. The sole remaining theoretical check on this power was inflation. However, even this hurdle could be systematically managed, first, through the careful manipulation of interest rates, and crucially, by perpetually persuading the public to maintain faith in the stability and integrity of the system itself. Between 1971 and 2024, the Federal Reserve injected well over $20 trillion into the system, fueling an exponential expansion of the money supply. Predictably, this massive liquidity influx caused asset prices, stocks, bonds, and real estate to explode in value. The fundamental question is, who were the primary beneficiaries of this historic surge? Unsurprisingly, it was those who already owned significant assets. And the lion's share of these assets, of course, belongs to the wealthiest families and the powerful financial institutions operating under their influence. The mechanics of the modern system are surprisingly straightforward. The Federal Reserve initiates money creation primarily through the purchase of government bonds, a process known as open market operations. When the Fed acquires these bonds from commercial banks, the banks receive new cash reserves. They then leverage this liquidity, lending it out and creating substantially more money through the mechanism of fractional reserve banking. Critically, whenever a major financial crisis erupts, the Fed drastically accelerates its money creation efforts. We saw this in 2008, with the initiation of roughly $4.5 trillion in quantitative easing, and again in 2020, with $5 trillion deployed in response to the COVID-19 pandemic. This newly generated capital flows directly to the banking sector first. The banks then utilize this capital to purchase assets, causing asset prices to inflate rapidly. The net result is predictable: the wealthy elite grow substantially richer, while the general population disproportionately bears the burden of rampant consumer inflation. While the original banking dynasties have certainly evolved, they have not vanished. These influential families strategically diversified their holdings. For instance, the Rockefellers shifted their focus toward expansive philanthropy and sophisticated investment management. The Morgan legacy underwent significant consolidation, merging with Chase Manhattan, and subsequently with Chemical Bank, ultimately forming J.P. Morgan Chase, which stands today as the largest bank in America, commanding approximately $3.9 trillion in assets. Meanwhile, the Rothschild family maintains a formidable presence in global finance through Rothschild & Co., a prominent advisory and wealth management firm with over $100 billion in assets under management. Similarly, the Warburgs, having merged their institutions with other banks, continue to exert influence in the financial sphere via various complex investment vehicles and substantial philanthropic foundations. Yet, the true epicenter of power has subtly migrated away from individual family names and into the colossal institutions they meticulously engineered. The Federal Reserve dictates U.S. monetary policy, having materialized $20 trillion since 1971. The Bank for International Settlements, BIS, serves as the crucial coordinator of global central bank policies, quietly gathering its 63-member central banks for meetings shrouded in secrecy and often enjoying immunity from prosecution. The International Monetary Fund, IMF, commands $1 trillion in resources, leveraging debt against over 190 nations and imposing strict austerity measures and structural reforms as the prerequisite for vital loans. Concurrently, the World Bank dispenses hundreds of billions of dollars annually for global development projects, funds that conveniently, and often primarily, benefit large Western corporations. And orchestrating and overseeing this entire global apparatus are the very banks descended from the original dynasties: J.P. Morgan Chase, $3.9 trillion in assets; Bank of America, $3.1 trillion, and Citigroup, $2.4 trillion. These behemoths represent the direct, modernized continuation of the Morgan and Rockefeller banks. Then there is Goldman Sachs, the quintessential modern powerhouse, infamous for its revolving door, where its executives seamlessly rotate between powerful governmental positions and high finance. A clear illustration: former Treasury Secretaries Robert Rubin, Hank Paulson, and Steve Mnuchin all share a common origin at Goldman Sachs. The symbiotic revolving door phenomenon linking Wall Street and Washington, a practice fundamentally established by J.P. Morgan, persists, yet the scope of the system has ballooned far beyond anything the original dynasties could have possibly conceived. Consider the scale: the Federal Reserve's current balance sheet stands at $7.7 trillion. Global central bank assets exceed $30 trillion. Total global debt has reached $37 trillion. And towering over all of this is the global derivatives market, valued at a staggering $600 trillion in notional value. The comprehensive financial infrastructure, meticulously constructed by these 5 banking dynasties over 2 centuries, now effectively controls a quantum of wealth that exceeds the combined gross domestic product, GDP, of every nation on Earth. Crucially, this empire operates almost entirely beyond the reach of democratic oversight. Citizens do not vote for the Federal Reserve Chairman. They have no say in the secretive policies formulated by the BIS. They certainly do not approve the stringent loan conditions imposed by the IMF. This entire system is structurally designed to be completely insulated from public pressure, ensuring that it can continually extract vast quantities of wealth through the mechanisms of debt interest and systemic money creation. Let us briefly summarize the 5 critical stages of this financial takeover. Stage 1, 1800 to 1850, control of government debt in Europe. The Rothschilds masterfully financed major wars, resulting in their firm control over 50% of all European government bonds by 1830. Stage 2, 1850 to 1913, expansion into America and capital integration. J.P. Morgan consolidated American finance, effectively integrating it into the dominant European banking dynasties. Stage 3, 1910 to 1914, creation of the Federal Reserve. The legislation was secretly drafted on Jekyll Island. Private banks retain ownership of the Fed, placing control of U.S. monetary policy squarely in the hands of Wall Street. Stage 4, 1914 to 1945, consolidation of power via global conflict. The creation of global institutions, the BIS, the IMF, and the World Bank, cemented bankers' permanent control over the global financial architecture. Stage 5, 1971, present, the Fiat Era. The gold link was permanently broken, unleashing pure fiat money and enabling unlimited money creation. Central banks, coordinating through the BIS, ensure that wealth overwhelmingly concentrates at the very top. The 5 seminal dynasties, the Rothschilds, Morgans, Rockefellers, Warburgs, and their affiliated families, did not establish their rule through military force or democratic elections. Their true power was exercised through the shrewd deployment of debt, the establishment of central banks, and the enduring global institutions those banks founded. These institutions remain fully operational today: the Federal Reserve, the BIS, the IMF, the World Bank, and J.P. Morgan Chase. All of them are immensely powerful, actively functioning, and deliberately shielded from the accountability of the voters. The staggering $36 trillion U.S. national debt raises critical questions. Who owns this debt? Bondholders. And who benefits most profoundly from the perpetual stream of interest payments? Ironically, the very same banking entities that were instrumental in establishing the Federal Reserve in the first place. The mechanism is self-serving. When the government needs to borrow, it issues bonds. The Federal Reserve then purchases these bonds by conjuring money into existence from thin air. The government receives cash, the Fed gains interest-paying assets, and the facilitating commercial banks collect substantial transaction fees. This is a perpetual motion machine where debt explicitly creates money. Money then creates inflation. And inflation, in turn, systematically transfers real wealth away from cash savers and directly into the hands of asset owners. The architects of these dynasties grasped this fundamental reality 2 centuries ago. He who controls the creation of money controls the wealth of nations, not through overt violence, but through the silent, relentless mechanisms of compound interest and calculated monetary policy. If this presentation has clarified how these banking dynasties systematically built the modern financial system, please subscribe, because the next video will analyze precisely what occurs when the colossal system they constructed inevitably collides with its own mathematical and fiscal limits. The current $37 trillion in global debt simply cannot be repaid under existing conditions. Consequently, central banks find themselves trapped, unable to cease the printing of money without instantly triggering a catastrophic system collapse. Tellingly, the very families and institutions that dictate global finance are already hedging their bets and preparing for the inevitable crisis by aggressively accumulating hard assets, gold, real estate, and vital commodities, while the vast majority of the public remains convinced that holding paper currency and digital tokens offers security. Understanding this history is merely the first step toward awareness. Understanding what comes next is the necessary path toward survival.